The European Central Bank has decided to raise interest rates.
Yeah, there had been a bit of speculation over the past few days, Tom, that amidst the turmoil of the last week or so, central banks might slow or even put on pause their steady pace of tightening monetary policy. The ECB did not do so. It pushed ahead with a widely expected 0.5 percentage point raise. That puts the key deposit rate for the bloc at 3%. Inflation in the Eurozone was 8.5% in February. That's still far higher than the ECB's 2% target. ECB President Christine Lagarde said the recent volatility in the banking sector was no reason to halt the bank's fight against inflation. And she said the European banking industry was resilient, but that the central bank could provide financial assistance if needed.
We are monitoring current market tensions closely and stand ready to respond as necessary to preserve price stability and financial stability in the euro area. I believe that there is no trade-off between price stability and financial stability.
Let's cross now to John Lear, chief economist for the decision intelligence company Morning Consult. Thank you for joining us on France 24. Your reaction to that ECB rate hike, were you surprised perhaps that the central bank went ahead with that 50 basis points rather perhaps than 25 given the volatility that we've seen this week?
I wasn't surprised only because the central bank was so clear in committing to that 50 basis point increase at their last meeting. So that was the forward guidance that they provided, and they really went essentially out of their way to not revise that guidance. I also think it's important to keep in mind that the ECB was slow in starting to raise rates, so they're not as far along as the Fed is in its rate hiking cycle. And that's one of the sort of pressures that the ECB faces, is to try to catch up with the Fed.
This rate decision risked really being overshadowed by the turmoil that we've seen in the banking sector this week. Lagarde and a lot of other European officials have repeatedly insisted that the banking system in Europe is not at risk of contagion, either from Credit Suisse or the two failed American banks. What's your assessment of that?
I would say the financial system in general is in the business of taking and managing risks, and that in a period of low interest rates, you're likely to see banks go out and take more and more risk in the search for yield. As interest rates start rising, I think we will see more and more poor risk management, more poor decisions having been made by banks, and it's really a matter of time to some extent for those decisions to be exposed.
Now, the ECB was the first central bank to meet since these market jitters began. The US Federal Reserve will be meeting next week. It's facing this dual challenge as well of combating inflation while trying to bring stability to the banking sector. Where do you see the Fed moving?
At this point, the Fed is fairly strongly committed to a 25 basis point increase. Not that long ago, roughly 5 or 6 days ago, I think markets were pricing in a 50 basis point increase, and that's essentially off the table at this point. 25 basis points seems like the most likely outcome, although it's possible that they pause rate increases. Again, the challenge that the Fed faces is that, that inflation remains persistent. We just got the CPI report out that showed persistent, elevated inflation despite rate increases. There's more work to go, but it's not clear how much more the financial system can digest and can absorb before we start to see other things break down.
Now, we know that the rapid rise in interest rates over the last year or so contributed to the problems at Silicon Valley Bank, which collapsed a week ago. Is that something that will play into the decision made by the Fed and by other central banks around the world?
They're not supposed to explicitly sort of be worried about any particular bank. I do think more broadly, there is sort of a concern around the timing. It's not just how much rates increase, but also the speed with which they increase. The Federal Reserve very consciously made a decision to front load those rate increases, so to be pretty aggressive in raising rates last summer and earlier this year. And so now they have a little bit more flexibility to take their foot off the accelerator, essentially, and see how the extent to which the economy can process and absorb those rate increases.
What's your take on this week's turmoil that we've seen in the banking sector? Are we heading for perhaps a global crisis here?
I view the events of this week as being symptoms of pretty broad, dramatic shifts in the underlying economy that have been going on for the last 2 years. And it's taken rising interest rates, again, to expose those shifts. So we had low rates driving excessive risk taking. Some of that's starting to be exposed. We've got in the US and globally, we've got commercial real estate, which continues to be, occupancy rates continue to be extremely low. That is sort of a bubble that we're waiting to see how that plays out. Consumers continue to shift their spending patterns away from goods towards services. That's making it, where that's driving a pretty dramatic shift in where workers are allocated, where workers are working. All of that change, it's not necessarily bad, but it introduces volatility into the economy, and it's unclear how the economy can process higher interest rates while all these other tectonic shifts are occurring.
John Lear, thanks so much for joining us from Washington this evening.
My pleasure.
Well, earlier on Thursday, Credit Suisse went some way to calming market jitters when it accepted a huge loan from the Swiss National Bank to shore up its finances. It will borrow up to 50 billion Swiss francs. That's around $54 billion. The bank had insisted that its cash position was solid, and it described today's decision to take that loan as a, quote, decisive action to preemptively strengthen its liquidity. Investors welcomed the announcement. After plunging as much as 30% on Wednesday, Credit Suisse shares rebounded by about as much earlier in the session, settling up 19% for the day. Later, though, a group of Credit Suisse shareholders in the United States sued the bank, accusing it of concealing problems with its finances. I'll bring you more on that story as we get it. Well, the week of turmoil started in the U.S. with the collapse of Silicon Valley and Signature banks, the biggest banking failures since the 2008 financial crisis. Now a group of 11 banks, including J.P. Morgan Chase, Citigroup, and Bank of America, have themselves agreed a joint rescue package of the First Republic Bank. Regulators say they've agreed to inject some $30 billion worth of deposits. The 14th largest bank by assets, First Republic has a large percentage of deposit accounts that go beyond authorities' usual $250,000 guarantee, meaning that they are uninsured. That was one of the problems for Silicon Valley Bank, too. First Republic's share price has been plummeted during the recent market volatility, but it was up about 10% as that news was confirmed at the closing bell, Tom.
Okay, thank you very much indeed. Kate Moody, our business editor, thank you very much indeed. I'll be back